Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, January 7th, 2023. Hope you're having a good day. Appreciate you coming here and watching my weekend review podcast of the trades that I took, all the trading activity that I participated in last week. Hope you had a good trading week. We had not a little bit, but we had a nice rally on Friday. Maybe gave the bulls a little bit of hope. We had the unemployment number come out. Even though the unemployment number was stronger, the wage growth was slower, and that was good news for the bulls and for the market. So we will see what happens next week. So here is the format for today's podcast. First of all, we are going to run the U.S. legal disclaimer. Then we're going to come back. We're going to take a look at all the positions and all the trades that I made last week. I made them on multiple time frames, daily time frame, weekly time frames. And one thing that I've used in my trading over the last 28 years really comes down to three principles. And the first principle is trade as many different markets as possible. Don't get too correlated in one particular market. I like to get outside of equities. I like to trade gold. I like to trade bonds. I like to trade the dollar. I like to have as much diversity as I can in different markets that I trade. Also, I like to trade as many different time frames as possible. I feel like it really evens out and smooths out your profit and loss, because one time frame may be working for you at a moment and then another time frame may not. So I day trade all day long on, usually the 5 minute time frame. I take my daily swing trades at the end of the week. On Friday, I look for weekly setups, and then at the end of the month, I also look for monthly setups, because one time frame may have just gotten you out, but in a higher time frame, it doesn't get you out. And then if it moves back up, then you at least have that time frame. It's very rare that all time frames are not working for you. So number one, I like to trade as many different markets as possible. Number two, I like to trade as many different time frames as possible. And then number three, I like to trade as many different trading approaches as possible. I don't just use one trading approach. I use 5 different trading approaches. So those are kind of the 3 pillars of how I look at trading. Trade as many different uncorrelated markets as possible, as many different time frames as possible, and in as many different trading strategies as possible. And so I'll go through all the trades that I made last week, when I entered them, why I entered them, and how I am going to manage them going forward. That is the most important part, in my opinion. Once we do that, we are going to talk a little bit about trader psychology. Always the most important skill in trading, in my opinion, is the ability to create a plan, follow the plan precisely without letting your emotions get in there and get amplified and get you out of your process. And by the way, probably the most important part of that equation is position sizing based upon the current market volatility. If you have too large of a position size, whether it goes up or down, you're going to be tempted to get out and not let your process play itself out. So position sizing, very, very important based upon the market's current volatility. And I will show you how to do that. It's quite easy. You just take your maximum allowed loss, you divide it by the value of the 2 ATR, and it tells you exactly how many shares to buy based upon your account value, what your maximum allowed loss is, and then, as I've mentioned, it accounts for the volatility of the market. If the volatility is higher, then the simple equation has you buy fewer shares to compensate for the high volatility. If the volatility is lower, then you buy more shares. So we'll go through that. But again, we'll talk about trading psychology. I always like to put this in here because I know from trading for 28 years how important the psychological aspect of trading is. It really is the most important. After that, I always like to do a poem from my friend Frank, the trading poet. He always writes great poems every day based upon what's going on in the market, and always like to share that with you. After that, I have gone down through my master watch list, and I have gone down and I've identified some potential trades next week that I'm looking for. I'll show you what I'm interested in. Usually the market has to go up further for me to get interested, or down further for me to get interested. If on the upside, needs to get into some kind of momentum, some kind of breakout, To the downside, looking for support at prices that are lower. So I've gone through both the dailies and the weeklies. I have identified what I'm looking for on the dailies, and then we'll switch over to the weeklies and take a look at those as well. Because of the rally that we had on Friday, not as many potentials as I usually have for you, but I still have a good 4 or 5 in each time frame. All right, so we'll go through that. I'll show you what I'm looking for. Hopefully that will be helpful for you. It's always helpful for me too, because I have to verbalize it and vocalize what I'm looking for exactly. And it's one of the reasons I do this podcast, because I think it's a win-win. I think it's a win-win for me. Teaching is always good. So we'll go from there, and I'll tell you what I'm looking for. Okay, so first of all, let's run the U.S. legal disclaimer, get that out of the way, and I will be back in about 40 seconds. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started on current position. Kind of a mixed week for me. Had some good trades, had some bad trades too, but that's what trading is, right? You have to take the good with the bad. But Friday's move up on the slower growth on the unemployment, the market liked it, and we'll see. We will see. Don't know. We can't make any predictions. I mean, obviously, if you're a bull, you want the market to go up, but at least the movement on Friday did give us some potential optimism in the market. So at least for me. Here we go. Let's start out with MasterCard. I did buy MasterCard back here on the 20th of December. Why did I buy it? Well, it bounced. It bounced right here at the confluence of the 250 and the 300 moving average. These are important moving averages that large institutional buyers and sophisticated investors key off of. The key in any trade is to have a good risk to reward ratio. If you see it reject the level, then you say, okay, there are no more sellers, at least temporarily, at these levels, and that's a sign of support, and that's a sign of why I want to get in. So I bought here on the 20th at 342.70 because during the day it went down, it tested, and it bounced right off. Now, when I see a signal, the first thing I have to do, once I see the signal, okay, yes, I want to buy this, what I have to do is I have to take my maximum allowed loss, and a good rule of thumb is 1% of your total capital. So if you have a hypothetical $50,000 account, 1% is $500. That's your maximum allowed loss. And what I do, let me get the calculator out here. So for this example, $50,000 total trading capital, 1% of that's $500. I take $500 and I divide it by the value of the 2 ATR. 1627 divided by 1627. That would tell me to buy 30.7 shares or 31 shares. So that's how many shares I'm going to buy. Now, my maximum allowed loss was 1%. And so doing that math, once I buy 31 shares, then I have to put my emergency stop exactly 2 ATRs below. So if I have 31 shares and it moves 16.27 points, that's my maximum allowed loss. That would be my $500 loss. So that's down here. I put my emergency stop exactly whatever the value of the 2 ATR was below me. Therefore, if the price moves down that far, if 31 shares moves 16.27, then I would lose $500, right? And if it gets to that maximum allowed loss level, then I sell it immediately. Usually on all of my swing trades, I wait till the end of the day or the end of the week or the end of the month to make my decision. But if it gets to my maximum allowed loss level, I don't care what time frame I'm trading. If it gets there, that's my maximum allowed loss. I can't wait and go, well, it's not the end of the day, so I can't sell it. No, once it gets there, then I have lost my $500. That is it. Discussion is over. But that only happens about 5% of the time. The other 95% of the time, when you take a loss, it will be an end of day loss. And my end of day loss is the opposite of really why did I take the trade? Well, I took the trade because it bounced at the 200, at the 250 and the 300. Therefore, if it closed below, I would get out for a much smaller loss. And that's the key to trading. Good risk to reward ratios, identifying your levels, getting out immediately when you are wrong. So the next day it moved up a little. And now I always take a partial profit, 10% of however many shares I have remaining if it moves the value of 0.45 ATRs from the previous day's close. So the next day, yes, it did move up that value. I took 10% off. The next day we went down below my end of day stop, but it recovered and closed above. That's the key. No profit targets on that day. The next day, it opened below and then closed above. That kept me in the trade. Then it moved up a little, and it moved up a little, moved up a little. Then we had a big day up here. I believe I hit 2 profit targets on this. So I like to play offense and defense. Defense, emergency stop, end of day stop, trailing stop process. Offense, taking profits when the market gives them. So I took some nice profits here. Then it pulled back, took another 2 profit targets here. And then on Friday was a big day up, hit 3 profit targets. So I'm scaling out. I'm taking advantage of the market giving me some profits and locking those in. So you can see this has been a great trade so far here. Worked out really nicely. Took 30% of the remaining shares that I had off on Friday. But this particular trade from entry to current price, up 6.8%. So pretty good there. And by the way, just wanted to mention, I do teach private one-on-one lessons in the evening time via Skype. I love to teach. I've taught students from all over the world. In this particular podcast, I go through kind of the basics, a high-level overview of what I am doing, but there are a lot of rules in my trading process, and I think you have to have them. Trailing stops, emergency stops, scaling out. And this is what I teach in my class. And I was mentioning before that I one of the pillars of my trading has been trading multiple trading approaches. And in the class, in the one-on-one, I teach you all 5 of the different trading approaches that I use, because sometimes based upon what the market's doing, I'm not going to have potential trades in one strategy, but I'll have another trade in different strategies. So regardless of what the market is doing, I do have a strategy that works well in that particular market. And if you want to learn how to trade, or anything else, guitar, ice skating, archery or trading, I really truly believe the best way to do that is with a one-on-one instructor who's been trading, has a lot of experience, and that's why I offer these. So if you are interested, my email is in the link of this YouTube video. Just reach out to me, and we can discuss it. But it's a great course. I don't think I've ever had a student that has not been happy that they've taken the course, and I'll talk more about this as well. So at the end of the podcast. So anyway, this particular trade up 6.8% from entry to current price. Nice trade there. Apple. All right, this is a different strategy. Of course, on MasterCard, we entered with a bounce at support. Apple, we took a different strategy, still a deep dip buy strategy. But what was the strategy? Well, the price closed below the negative 30 RSI, or the negative 30 RSI, and then closed back above. That's a good sign. That's showing that the market tested the levels below 30 RSI, and then the next day rejected them and stayed above. You can see here's and that is why I took the trade. It closed below the 30 RSI and then closed above the 30 RSI. Cherry on top was that we also we closed below the negative third ATR channel and then closed above the negative 30 ATR channel. I would not take a trade just based upon that, but it does strengthen the under 30 over 30. So I under 30 over 30, I bought here. I position size by taking my maximum allowed loss, dividing by the value of the 2 ATR of that day. That is how many shares I bought. Then I place my emergency stop 2 ATRs below my entry so that if it does get down there, then, and if it were to touch that, I would immediately get out and lose the hypothetical $500. That's the emergency stop. The end of day stop is simply a close below the 30 RSI, and it never did close below. It got close on this day. Had it closed below, I would have gotten out, but it held the 30 RSI, my end of day stop, and that is why I continued to hold the trade. We moved up, took a little profit target here, did hit 2 profit targets on Friday with the nice move up, and so thankfully this trade barely in the money. 129.50, it's at 129.62, but it's still a nice feeling to have gotten back in the green after, when I initially took the trade. I mean, it just was, taking the stairway down, but it did recover. It's a good sign. So this trade is up hardly anything, but still something. Let's take a look here. Yeah, it's up about 0.09%, but happy with that. Now, orange line up here is my trailing stop level. Once we get to trailing stop level, then I have different strategy. I have a different process, and which actually is, if it gets to trailing stop level, then we're in trailing stop mode, and then subsequently, or in the future, if I get a close below a previous bar's low, then I would get out of half, lock that half in. But we're not to trailing stop level. Once we get to trailing stop level, then that kicks in. And again, these are all the strategies and all the process that I teach in my one-on-one courses. So as long as this stays above 30 RSI, I will stay bullish on Apple. If it hits my emergency stop, I immediately will get out. If it closes below the 30 RSI, that's my end of day stop. I'll get out. If it gets to my trailing stop level, then I go into trailing stop mode. And of course, as always, I take partial profits if it moves 0.45 ATRs. For instance, we are now at 129.62. So for Monday, I'll take 129.62. I'll add the value of the 0.45 ATR, which is now 195. So I'll take 129.62, add 1.95. That will be my first profit target on Monday. I'll take my first profit target, add the 0.45 to it again. That will be my second profit target. I'll take my second profit target, add 195 to it again. That will become my third. And if it gets to my first profit target, I'll take off 10% of what I have. If it gets up to my second profit target, I'll take off another 10%. If it gets to my third, I'll take another 10% off. And then the next day, I'll do the same thing. I'll take the new closing price, add whatever the value of the 0.45 is at that day, because it changes every day, and so forth and so on. All right. Okay, ARK. ARK is a brand new trade that I took on Friday. And why did I take the trade? Well, this is called a V1 entry signal. And by the way, if you go to my YouTube channel, I have a video there called V1 and V2 entries. Kind of the bread and butter of my trading. Great entry signals. They're very easy. And we had one here, and I'll just point it out to you. Here's Thursday is bar 1. Friday is bar 2. Do you see how we went below bar 1's low? And then we closed above bar 1's close, and it happened inside of the value zone, the 2 green lines here. And in addition to that, I like that MACD just went green. That helps. So this is called a higher low V1. We close below the -1 ATR channel. We pop our head into the value zone. We pull back. We go below the previous bar's low, but then close above the close. That is the entry signal. Now, as always, I position size by taking my maximum allowed loss, dividing it by the value. Here we go. Let's just do this. So again, hypothetical $50,000 trading account. 1% that's $500. I take $500. I divide it by the value of the 2 ATR, which on yesterday was $3.01, divided by 3.01. It tells me to buy 166 shares. Now, if 166 shares gets down to my emergency stop, which is exactly 3.01, then I lose the $500. Again, it only about 5% of the time will that happen. Now, that's your emergency stop, but what about your end of day stop? When you have a V1 or a V2, your end of day stop is a close below halfway of the washout bar. And I call this the washout bar because it washed out bar 1 and reversed back up. So you can see my risk to reward hypothetically is very, very good. I don't know if it's going to go up. If it closes 1 penny below Friday's half point, which is 30.76, then I just get out, ideally, hopefully, for a small loss. Worst case scenario, it gets to my emergency stop and I get out and I lose the $500. So we always want to think about risk first, where our emergency stop, where our end of day stop is. But simply on Monday, if it closes below halfway of this bar, 30.76, I will go ahead, just get out of the trade. Now, on the upside, I have my trailing stop level here, 33.64. You can see the 1.5 ATR is $2.26. So I take my entry, I add 226 to it. That becomes my trailing stop level. If I get to trailing stop level, then I just go into trailing stop mode, right? So you have to have a plan regardless. The worst case scenario, end of day stop. Second worst case scenario, close below halfway the washout bar on this V1. Get out if it closes below halfway. If it moves up, well, I take my current price, the current closing price, 31.36. I'll add the value of the 0.45 ATR, which is 0.68. That'll be my first profit target. Add it again. My second, add it again. That's my third. So if it moves up, I start taking partial profits. If it gets my trailing stop level, then I go into trailing stop mode. So I've got it covered regardless of what happens. Unfortunately, we cannot force our will upon the market, but we have to have if-then statements. If it does this, then I do that. If it does that, then I do this. And this trade is set up perfectly. Of course, I don't know if it's going to go up, but I know exactly what I'm going to do regardless. And that is a really good thing in trading. And you have to have that. And again, these are all the things that I teach in my one-on-one course. Okay, so that's ARC. I got in at 31.27. It's 31.36, up slightly. We'll see what happens on Friday. UNG on the week. No, this is daily too. Yeah, these trades did not turn out so great, but they don't always turn out so great. I bought UNG back here, natural gas, on the 4th of January. We had an under 30, over 30. That was the signal. I position size, I placed my emergency stop all the way down here. The next day, it collapsed. It closed under the 30 RSI. So my my end of day stop kicked in and I took a loss of 10.45%, which sounds horrible. But it's not as horrible as it sounds because my emergency stop was way down here at 1060. People say, oh, does that mean you lost 10.45% of your account? No, of course not. If it had even gotten down here to 1060, how much would I have lost? Well, my maximum allowed loss was 1% of my capital, right? So the percentage move down was horrible, but because it was such a small percentage of my capital, it was like 0.5% of my capital. So I want to make sure, because I do get questions on that. If you get to your emergency stop level, you will lose 1% of your capital, even if it's 25% down. Makes sense? So I did exit the trade with a loss of 10.45%, but it was really only about 0.5% of my total capital. So out of UNG, not a great trade. GDX, another losing trade. However, I think this is a good learning opportunity. I did short GDX, which are the gold miners, back here on the 29th of December when we rejected the 200-day. This is a short position. We have double tops, bearish divergences here, and it closed above the 200, closed below the 200. Then the next day we tried to get above the 200 and then failed again. That was a sign that, okay, it does not like prices above the 200. So I shorted. The next day it did go down, took some profit targets, thankfully, because it helped mitigate the loss, big picture. And then this day, on the 3rd, we closed back above the 200. that was my end of day stop. Up here, my emergency stop. Had it got all the way up there, then I would have lost 1% of my capital. But my end of day stop was a close above the 200, and thankfully I took it. It's never fun to lose on a trade, but there is some satisfaction when you get out of your trade with the stop and it keeps going up. Imagine this. Imagine if I had not followed my rules, and look, it just skyrocketed after that. But luckily I got out here and got out for a loss of 2.39%. But it's always a good feeling when you take your stop and then it continues against you because you are out. Because if you really thought it was too high here, what are you going to do here? What are you going to do here? And that's when you can really get into problems if it just continues and goes against you. That's why you have to have your level. My level was if it closed back over the 200, I'm out, and that's it. And thankfully, I did get out for a loss of 2.39%. All right, let's head over to some weekly trades. Again, I like to trade multiple time frames. Okay, here's the Russell 2000. I take my weekly trades on Friday because that's when the bar closes. I bought IWM here at 167.19 when we went below the 300, closed above the 300. My end of day stop is a close, just simply a close below the 300. Of course, I have my emergency stop down here as always. I place my trailing stop level 1.5 ATRs above, and then of course I scale out on the way up. Well, the next week had a nice move up, scaled out, took some profits. Next week also moved up, took some other additional profits. Once we got to trailing stop level, now I'm in trailing stop mode, which means if it closes below a previous bar's low after reaching that trailing stop level, then I get out. Well, continued up, continued to take partial profits. Back here on 12.9, it had its first close below the previous bar's low after reaching trailing stop level, and I locked in half of my position. Okay. Next week went up, did hit some profit targets, thankfully, before it reversed back down. It is still holding the 300-day or 300-week moving average in this case, so I am still trading, or I'm still in this trade, still bullish until it closes below the 300, or conversely, if it moves up. Now, if it moves up, gets to a 65 RSI level, then if I get a close below the 5 EMA, I'm completely out. If we reject the 70 RSI level, if it really moves and rejects the 70 RSI level, I would also get out of another half. Then, if I have a close below a previous bar's low after rejecting the 70 RSI, I would then be completely out of the trade. So again, you have to have all these if-then statements. If it does this, then I do that. If it does this, I'm going to do that. So this particular trade from entry to exit with the remaining shares that I have up 5.83%. Microsoft, okay, another deep dip buy signal, bounce at the 200, position size entered 221.34, place my emergency stop 2 ATRs below, place my trailing stop 1.5 ATRs above, moved up nicely the next week, took some profits off, got into trailing stop mode, moved up again, took some more profits off, moved up again, took some more profit targets. Then we have a close below previous bar's low after reaching trailing stop level, got out of half, thankfully. And next week, didn't do much. Then last week, Microsoft got a downgrade and had a big down bar. And you can see my end of week stop on this trade would have simply been a close below the 200. It bounced again. This would have been a legitimate trade again on Friday had I not already been in the trade, because it tested the 200 and survived it, giving you a decent risk to reward ratio. Very similar, you can see, to where I took the trade back here. So not fun that it came down on Friday so much with that downgrade. But again, the importance of taking off partial profits when you're moving up, the importance of having a trailing stop level procedure in place. I mean, I'm really glad that I took half of the remaining shares off at 239.50, because now it's 224.93. So it all plays in together, kind of like an orchestra. There's a lot of different things going on. Emergency stops, end-of-day stops, trailing stop levels, partial profits, right? And again, that is what I teach in my private one-on-one lesson, are all these dang rules. And so currently on the remaining shares that I have on Microsoft, up 1.67%, but up more than that because of the profits that I took and the trailing stop that I locked in. But still positive on, still bullish on Microsoft until it closes below the 200. And at that point, I would just go ahead and get out. Joe. Well, Joe is coffee on the weeklies. I took this with a confluence of signals here, bounced at the 200-day moving average, also had an under 30, over 30, very strong signal, gave me a good risk to reward ratio, entered here at 44.28. You can see the orange line up here is my trailing stop level. Never quite got there. Had a big down move this week, but again, I want to point out the importance and the value of taking partial profits when the market gives it to you. I bought here 44.28. The next bar moved up. I took 10% off. Next bar, no profit target. Then we head down. Then this week here, from here to here, from 44.90 up to 49.20, took 2 profit targets off there at profitable levels. Have not reached trailing stop level, so that does not go into effect. Had a big down bar this week, down 5.25%, but still holding the 200, and therefore I am still bullish on coffee. This particular trade currently up 2.43%. Google. Again, weekly trade. I bought this back here on the 23rd of December. Why? Because we had an intra-week rejection of the 250-day or 250-week moving average. This is a deep dip buy. So I position sized, I bought, I placed my emergency stop 2 ATRs below. Where is my end of week stop? Well, end of week stop is simply a close below the 250. The next week, it did go below the 250 on intra-week and then close back above. I held the trade. This week went up a little bit, then came back down and just barely closed above on Friday. The 250 is 87.13. We closed at 87.34. It's still above, so I'm still bullish and holding the position. In addition, we're different one, different stock. I'll get to that in a minute. So this particular trade at the moment down about 1.72%. And next Friday, if it closes below the 250-week moving average, I'm simply out. If it hits my emergency stop somehow, I'm simply out. If it moves up, then I'm going to take partial profits. Okay, SSO, new trade that I took on Friday. Good example here of a good risk to reward ratio. We have a close under and a close over the 200-week moving average. The 200-week moving average is 45.41, and we closed at 45.69. I position sized, placed my emergency stop 2 ATRs below. Where is my end of week stop on this? Simply any close below the 200. If it closes 1 penny below the 200-week moving average, I will get out, hopefully for a small loss. Even in the worst case scenario, if it gets all the way down here, I've only lost that hypothetical $500, right? But this is a very good example of a good risk to reward ratio. If it's above the 200, it has the support of the 200. I want to have support below me instead of resistance above me. Don't know what's going to happen here, but I do know that if it hits my emergency stop, I'm out and I've lost what I can afford to lose in the worst case scenario. If it closes next Friday below the 200, then I'm just out for a small loss. If it moves up, then I'm going to take partial profits. 45.69 plus 194, that's my first profit target. Take the first profit target, add the 194 to it again, that's my second. Take my second, add it again, that's my third. So I'll have 3 profit targets in the system. In case we have a nice big move up, I want to take some profits when I have them. If we get up to trailing stop level, which is 1.5 ATRs above, I go into trailing stop mode. And then if I have a close below previous bar's low, I get out of half. Make sense? So anyway, I'm glad that we could close above the 200. That's important. It's always nice to be above the 200 with a good risk to reward ratio. And then Tesla. Tesla, I took a loss on Friday. I had to get out. Glad that it was mitigated a little bit with the reversal on Friday. I did take Tesla here within last Friday, not last Friday, but the Friday before on the 30th. We went below the 300 week moving average, closed above. That was my signal. Emergency stop. Where's my end of week stop? Just simply a close below the 300. And that's what happened on Friday. It simply closed below. I'm out of the trade for a loss of 6.16%. All right. All right, let's head over to trader psychology. This is from the Divergent Trader, Alan Edwards. You can follow him at Trader Divergent on Twitter. I really liked his channel. He posts great information. They're very short and succinct, but they carry a lot of weight. And let's see what Alan has to say today. Patience beats talent. Very important. We can all be, you can have a knack for trading, be very talented for it, but really at the end of the day, patience, waiting for your setup, waiting for your confluence combination of good indicators lining up at the same time, giving you a good risk to reward, that's what's going to get you the money in trading. You won't have a profitable trade every trade, obviously, but you're going to put yourself in a position of good support, multiple time frames lining up, good entry signals giving you a good risk to reward ratio, and you have to be patient and wait for that. That beats talent. Discipline. Well, discipline and patience, they're cousins at least. You have to have the discipline to wait and be patient, and discipline also beats talent. And then consistency beats talent. Patience, discipline, consistency. And consistency to me means being consistent in following your trading plan, your trailing stops, your end of day stops, your trailing, your emergency stops, taking your profit targets, being completely consistent in what you are doing, not getting a bias on the market, letting the price tell you what is happening, not listening to stories, talking heads on TV, news reports, articles. Anyone can write whatever they want, but what the price is doing is the actual truth of what's happening in the market, and that's what you need to follow. So you need to be very consistent in your process. I know it's fun to go out there and gunsling and make a little here, boom, make a little there, but at the end of the day, the consistency of a good trading system, a good trading policy and process, that's what's going to keep you in the game. That's what's going to make you a better trader, and in the long term, that's what's going to get the money. Think about casinos. They are very consistent in the games that they play, right? You can't bet more than this in some casinos, right? Because they don't want to take on too large of risk on any one trade. Well, every trade, every roll of the dice, deal of the cards, spin of the roulette wheel, that's a trade for them, and they have an edge in that trade. They don't win all the time, obviously, but over the long term they win, and it's a very good example for us in trading. Being patient, being disciplined, and consistent with a good trading approach and a good trading process. And that is what I do teach in my one-on-one lessons. I teach you all of this, but I teach you the trading process with the emergency stops, the end of the day stops, the profit targets, the trailing stop levels. That is what I teach, and that is what you have to be consistent in. So patience beats talent, discipline beats talent, and consistency beats talent. Thank you very much, Alan. I appreciate that. Great post. Please follow Alan over at Trader Divergent on Twitter. All right, before we get to this coming week's potential trades on the daily and the weekly timeframes, just want to do a poem from my friend Frank. You can follow Frank at FrankOD over on Twitter. Let's see what Frank has to say today. News in the morning, updates at night, determined to mess with a setup just right. That's true. When it goes our way, that's a delight. But trading in a market when money is tight, test a trader's patience, and that's being polite. Isn't it true? News in the morning, updates at night, determined to mess with the setup just right. Yep, you always have that news risk. You always have that headline risk that you can have a great setup and then have some bad news come in and mess the whole thing up, right? When it goes our way, that's a delight. Of course, that's a delight. But trading in a market when money is tight, which it is now, test the trader's patience, and that's being polite. Testing a trader's patience. Remember, we just talked about patience in trader psychology. It tests your patience, and that can get you off your track. That can get you off your process. And that's what we are really trying to avoid. When things are going great, it's easy to like follow your plan. But when things are not, it tests our patience, and that's where we can get into trouble. So, but trading in a market when money is tight, test a trader's patient, and that's being polite. Yeah, a little bit more than testing the patience. It's that's a nice way of saying it, and that's why he said that's being polite. Great poem, Frank. As always, please do yourself a favor. Follow Frank at FrankOD over on Twitter. Okie doke. Well, let's get to potential trades for next week that I am looking for, what I'm interested in. Here we go. Here is Amazon. Now, Amazon on Friday was a legitimate trade. We had a V1. Remember I was talking to you about the V1, V2 entry triggers. Here's bar 1. Thursday, Friday, we go below bar 1's low, and then reverse and close above bar 1's close. This is an important pattern because it's showing that the market tested the lows of Thursday, didn't like them, reversed back up. Now, I didn't buy this. I bought ARK instead with a similar pattern. But what I'm looking for on Amazon, because we had such a big move up, if I would have taken this trade on Friday, of course, I would place my 2 ATR emergency stop below. This is the washout bar because it washed out Thursday's low, and here's halfway. If it had closed below halfway, if I would have taken the trade and then in the coming days, it had closed below halfway of this bar, I would just get out. Now, we had the big rally on Friday. I would be surprised if we were to come back and test this level. It's very possible. Very often when you have a V1 or a V2, the market will come back down, test the level. So what I'm looking for this coming week is if it does come back below, or if it bounces at that level, closes a little higher, or if it goes below and then closes back above. It doesn't close below, I'm sorry. If it comes back down intraday, goes below and closes back above, that will give me an even better risk to reward ratio on Amazon. From a Fibonacci standpoint, you have the high, you have the low. 50% of this should hold. If it doesn't hold, then if I took the trade on Friday, I would be out. But if it does go next week, if it goes below intraday and closes back above, then I will take the trade. It will just give me a better entry position with a better risk reward. Because imagine if on Monday, if it goes below intraday and then barely closes back above, I would take that trade because then my risk reward is even better. Right now, it's a little chasey. And I also took ARK with the same position, and I also have a lot of longs as well. So, like I said, not a lot of symbols to look at this week because of the move that we've had. But again, that is what I would be interested in on Amazon. If next week we go intraday below halfway and then close back above, that would get me long, and that would give me an even better risk to reward ratio. In addition, we have a double bottom and a bullish divergence here. Very important. I studied one-on-one with Dr. Alexander Elder. His favorite technical indicator is a double bottom with a bullish divergence. And what is that? Well, here we make a low. You see how we have red MACD bars? This is a momentum indicator that shows that this move down was fairly strong because it painted red bars. So that's requirement number one. You have to have a low. You have to identify the depths of the MACD bars. Then we have to rally into green bars, which we got here. And then after we have that rally that makes the green bars, if we come down and we test that low and there's less red bars, that means the second move down momentum was not as strong as the first. And the implication is you're running out of sellers. You're running out of selling momentum. And the other implication is that if you run out of sellers, that you're going to go up. So I really like this double bottom, bullish divergence, even better than a bullish divergence because we don't even have a missing right shoulder. We have no red over here. Even a little less red would be valid, but there's no red, which makes this better. So double bottom, bullish divergence. We have a higher low V1, which means we closed below the -1 ATR channel. We rallied into the value zone. We pulled back. We had a false breakout from Thursday's low and then a reversal. This is all very bullish. But again, I did not take this trade. I'm waiting next week just to see if we can go intraday during the day and close back above. The structure of the trade would still be valid and would even give me a better risk to reward ratio. Or it might just head on up. And if it does, great. I have other long positions, right? Anheuser-Busch. All right, this is a short position. And I was just talking about Dr. Alexander Elder, double bottoms, bullish divergences, double tops, bearish divergences. And that is what we have. In addition, we have abandoned babies here. This is a very bearish scenario. But let's go through the double top with the bearish divergence. Here we make a high with green MACD bars showing positive momentum. Then we have to pull back to red, which we did. Here's the red. Then we went higher. But see how there's no green here whatsoever? That is a double top with a bearish divergence and a missing right shoulder. In addition to that, we have abandoned babies. Abandoned babies means we have bars with gaps to the left, gaps to the right. That is very, very bearish. So on, let's see, Friday, Thursday, Wednesday. On Wednesday, we had another abandoned baby here. Gap to the left, gap to the right. Again, bearish in conjunction with this double top bearish divergence. We're moving higher, but we're not moving high enough or strong enough to even paint any green bars. This to me is very, very bearish. Now, the signal to get short here is if we reject the high of the abandoned baby here, 61.57, that will get me short. Especially bigger picture context that we have abandoned babies, we have bearish divergences, we have RSI divergences. What's an RSI divergence? Well, here, look how high the RSI was. Now, we got back just as high over here, and it was lower. These are all bearish divergences. And bigger picture, Budweiser, Philip Morris, these consumer defensive stocks, that's where money goes for safety when the market is weak. Because people know people are going to buy their Budweiser, they're going to buy their cigarettes, they're going to buy their toilet paper, right? Regardless of what's going on in the economy. So bigger picture, what this is showing me is that with these bearish signals, the abandoned babies, the bearish MACD, readings, the bearish RSI readings, what this is telling me, if you kind of read the tea leaves, is that these consumer defensive stocks where money has been flowing into, starting to get weak. The implication for that to me is that money is starting to come out of these stocks and back into more growth stocks like Apple and Google and so forth. And if we look at the charts, it's telling us the same thing, because Apple, Google, more growth-oriented companies are starting to reject levels to the downside. So in my opinion, money is flowing out of these defensive names back into some growth names. So again, the short that I'm looking for on Budweiser is if we test the high back here on the 4th of 61.57, if we reject that, if we go above and then close back below, that will get me short. And the same thing, I'll place my emergency stop. My end of day stop will just simply be a close back above that. But I'm seeing these consumer defensive stocks getting weak. And I think that is good news for the rest of the growth-oriented market. Fiverr. Okay, we've been talking a lot about V1s, V2s lately. Well, Fiverr is setting itself up for a nice V2, but this can only happen on Monday. This is a higher low V2 requirement. We close below the -1 ATR channel. We rally into the value zone, which we did. Then we come back, pull back. And here is bar 1, bar 2. Bar 2 goes below bar 1's low. If Fiverr closes on Monday, and only Monday, above bar 1's close at 29.35, it will be a higher low V2, which is a very good risk reward ratio. I like that we also rejected the -1 ATR channel. That is really good news. And again, on Monday only, if we close above 29.35, that would get me long. And you know, the reason that these work are, look, if you were fortunate enough to buy down here for whatever reason, well, you've had a nice move up. If it had continued to go straight up, the people that bought here would not have been selling. But it got weak, it started to move down, people locked in their profits here. And so as we move back down here, again, the selling down here is most likely coming from the people that bought here when it got weak. If we can get a higher low V2 on Monday, that could be the beginning of a new uptrend. It really, really could, because everyone that wanted to sell here sold. And it started to go up because we ran out of sellers. Well, then we had a new group of buyers buy here. It moved up, got weak. They sold. So it's like a sponge. You know, when you take a sponge, it has a lot of water in it, you wring it out first time, a lot of water comes out, but then you can also wring it out again and get a little bit more out. That's what's happening here with sellers. We wring out all the sellers here. We got some new buyers that then sold. Now we're getting rid of some other sellers. If it can move up here now, it has a chance of having a nice, easy leg up because we don't have anyone selling into us anymore. People that wanted to sold here. People that wanted to sell again sold here. So again, MACD is positive. We rejected the -1 ATR channel. That is also a good sign. But again, Monday, if and only if it goes and closes above 29.35, I would get long FVRR, Fiverr International. Microsoft. Okay, so I'm still long Microsoft, but we are at a 3604 RSI. Now, if next week Microsoft goes under 30, over 30, very simple. If it goes under 30, either intraday or it closes below 30 and then closes back above, I would also get long Microsoft. Tesla. Well, Tesla's been a tough one, but I see a lot of traders, if they take a trade and they lose and untriggers their entry signal, then if it re-triggers, they don't want to get back in. Just human nature. Well, look at Tesla. Tesla by itself on the daily was a legitimate entry signal on Friday. We went under 30 and closed back above 30. We went under the -3rd ATR channel, closed back above it. That's also good. We also have a bullish engulfing bar, which means we went below the previous bar's low and then closed above the previous bar's high. This is all very bullish here. Now, I didn't take the trade, but what I'm looking for is another rejection of the 30 RSI and then close back above. That would give us a higher low under 30 over 30. A lower low under 30 over 30 is valid, but a higher low under 30 over 30 is better. Anything higher low is better than lower low. And so we came from a lower low and went under 30 over 30. But it's possible we're at 30.72 that next week we again go below 30 and then close back above 30. And if it comes from a higher low position, that would be even better. So that's really what I'm looking for on Tesla. All right, those are the dailies. Let's take a look at the weeklies. Again, the weeklies are, these decisions for me are made on Friday because that is the end of the week and that's the end of the bar. I'm looking for a short position on AGQ if and only if on Friday, sometime during the week, we had gone above the 200 and closed below the 200, giving me a good risk to reward ratio. Has not done that. I've been talking about this for several weeks. Hasn't got there. I'm just being patient, waiting for that signal. Now, the rejection of the 200 just by itself, it gives you a good level to key off of, but I always like to look at the higher time frames on all my trades to see if there's some supporting resistance or support on those higher time frames. Well, if you're trading the weekly, you want to look at the monthly as a higher time frame. Well, we have resistance here. We have the 100-week moving average. We have the 50 EMA moving average. There's kind of a nesting of moving averages here of resistance. It doesn't mean it can't get above it. It certainly can. But looking at the big picture here, these are some pretty significant levels of resistance on the monthly, but I'm trading the weekly, and those monthly resistance levels dovetail nicely with the 200, and it gives a good level. So again, just to sum up, next week, if we go above the 200 and then close below the 200 by Friday, I would get short. I'd place my emergency stop 2 ATRs below, my end of day stop, or my end of week stop in this case, would just simply be a close above the 200. AMD. Well, AMD did have a valid signal on Friday just by itself. You see how we rejected the 250? The 250 is at 63.22. We're at 63.96. It certainly went below the 250 and then closed back above. That is completely legitimate. I didn't take the trade. What I'm looking for next Friday is if we have a V1 or a V2. Well, it's formatted itself. It has set itself up for a potential higher low V2. Here is bar 1. Bar 2 goes below bar 1's low. If Friday it closes above bar 1's close at 64.77, that will give me a higher low V2 entry. V1's higher low V1's V2 entries are my favorite because it's generally, not all the time, but in a large majority of cases, that's the beginning of a new uptrend. So if AMD closes above 64.77 and gives me still a good risk to reward ratio, I will get long AMD. I like also that we've rejected the -1 ATR channel. I like that MACD is positive. So really looking forward to a close above 64.77 on AMD. And again, I know I'm talking about 250-day moving averages, 300-day moving averages, different time frames, higher low V1s, return to value V1s, V2s, all this kind of stuff. I know it can sound confusing, but it's really not. But again, in my one-on-one courses, I teach you all this step by step. And when you're done, it will give you a really nice skill to be able to go in, identify all these kind of things. So again, my email's in the link of this YouTube video. Please reach out to me if you are interested. NVIDIA, here we go. Well, I have been talking about this for weeks as well, but I would love to see next week, if the market heads down, I'd love to see some kind of intra-week rejection of the 200, which is the black line, or alternatively a close under, close back over. But really for me to get interested in next week to get long NVIDIA, it would just have to be a bar that comes down, goes below the 200, and then closes back up. In addition, this will give me a higher low. I keep talking about higher lows, right? Well, look, we had a close under, close over the 200. That's fine. That's totally legitimate. You would have had a nice area of movement in here to make profits for sure. But it came from a lower low. Now, if we can come back down, we did have a pretty significant move up, and a pullback is not out of the question and tends to happen a lot. But if we were to come back down, go under the 200 during the week, and then close back above, it would be a higher low rejection of the 200, where this was a lower low rejection of the 200, and just give you a good risk to reward ratio. So I'm looking for NVIDIA, simply an intra-week rejection and close back above of the 200 to get long on the weekly time frame on NVIDIA. Tesla, okay, I had this trade last week, did not work out. I had to follow my rules and get out. Remember, I took it with an intra-week rejection of the 300 and a V1, and then it closed below. I have to get out. However, look, we're still within striking distance of that 300. And we could potentially, if we close next week back above the 300, we could also close above the previous week's close, giving us a V2. And I always talk about confluence combinations of indicators. A close under the 300 and back over the 300, and also a V2 combination confluence of indicators. And I would definitely take that trade. So Tesla, if it closes back above the 300 next Friday, I will get long. Keep in mind, earnings are on the 25th of this month. Of January. So if that happens, and I'm long the trade, regardless of how much I'm up, how much I'm down, I always am going to get out for earnings. I never hold through earnings. It's just a gamble. You just don't know what's going to happen. As a trader, your first responsibility is to manage risk. And managing risk means don't put yourself in a position where you could have some big surprise. Well, of course, if you hold through earnings, that could be a big surprise. Good way to make money very quickly, or a good way to lose money very quickly. So again, Close back above the 300 next week on Tesla would get me long. Last but not least, USO, which is oil, looking for a pullback and entered weak rejection or a bounce at the 200, giving me a good risk to reward ratio. Good risk to reward ratio. Pretty good, pretty simple there. So for dailies and weeklies, that's what I'm looking at. I've mentioned it a couple times, but I really do think what I offer in these private one-on-one lessons is really helpful. It's very important to me that my students become good traders. It's good for my brand, good for my business, and genuinely, I want people to succeed in trading. When I was in my 20s, I had a really tough time with trading, lost a lot of money, and I spent the last 28 years really trying to master and learn these markets. And one of the motivations to start this podcast was I wanted to teach people because it can really change their life. And so, like I said, I teach you everything, all 5 of the approaches that I have. I teach you step by step. The total course is 15 hours, 5 sessions, usually once a week, one session. Each session is 3 hours. So 3 hours times 5 sessions, 15 hours total. It's really worth every penny. It does cost $1,750, but it really is worth every single penny, and I know you're going to be happy. And if you are interested, my email's in the link of the description. Just reach out to me and say, Greg, I'm kind of thinking about maybe taking your course. I'll reply and say, great. Let's set up a Skype call. The Skype call is free. It's not a sales call. I promise you it is not a sales call. It's just I want to learn more about you and your trading challenges and your goals. It's a good time for you to ask me any questions about the course. And then when we're done, it's completely in your hands. I will never contact you, send you email checkup. You'll have to contact me back after the call if you want to set up the lessons. And I hope you do, because it's going to be good for you. You're going to learn a lot. And I think it'd be one of the best decisions that you ever made. Now, if you like online courses, I have a great online course available at udemy.com. The link is in the description of this YouTube video. I have sold so many of these courses. It's the deep dip buy stock trading strategy. It's only one of the 5 strategies that I teach, but it's a great strategy. And almost in the last, couple months, everything has been deep dip buy signals. And on Udemy, I have that course. I teach you step by step. It only costs between $12 and $15. So it's a huge value because it's 9.5 hours of instruction, 26 videos total, 15 study guides. And I've gotten so many good reviews and feedback from all over the world on this course. The one-on-one course, obviously the best. But if that's a financial constraint for you, starting with the $12 or $15 deep dip buy strategy, I think you'd be very, very happy. Number 3, if you like today's podcast, I would appreciate it if you could hit the thumbs up button. It helps to build the channel, helps keep the channel around, lets YouTube know that there's some valuable content here. A lot of people out here, especially in this market, could use some good guidance and some good trading principles that I teach on this podcast. So if you would hit the thumbs up button, that just helps YouTube share it more and more people watch. And then lastly, and always the most important, please try to go out and do something nice for someone today. It really would make the world a better place if we could just do one nice thing for another human being. You like it when someone does something nice for you, or if you're in need, if someone's there. It doesn't have to be something big. Just hold the door open for them, give them a smile, help them pick up their whatever they dropped on the floor. Just do something nice each day. If we all did that, it would make the world a better place. And of course, if you know me, I'm a huge animal lover. If you could please try to go out and do one act of kindness, one nice thing for an animal, they would really appreciate it too. And it's all good karma, right? So anyway, thank you for coming today. Friday gave us a little hope on the bull side with the slowing growth on the unemployment. We'll see if we can continue that into next week. That would be wonderful. Obviously, a lot of people need it, but again, we have to follow our signals. We have to know exactly what we're doing. We have to position size correctly. all the stuff I've been talking about in this podcast. So I hope you have a good rest of your weekend. I appreciate you spending your time here. I hope by doing so that it is helping you learn some good trading principles, at least the way that I look at it and that I teach it. And if you have any comments or questions on this video, just please leave them in the comment section. I will do my best to answer them for you. So thanks again. On the way out here, I have to run the U.S. legal disclaimer, but have a wonderful rest of your weekend. Hope you have a good trading week next week, and God willing, I'll do the podcast again next week. All right. Take care, everyone. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.